now go across to S. Krishnakumar. He's our first guest on the show. Thanks so much, sir, for taking out time for us. Let's start with, how things are moving in the market. What do you make of the Indian markets now versus what they were in December, or, towards Diwali, the sort of optimism that was there?
Yeah, I think there is a sustained continuity of the global uncertainties that have been hampering the markets globally. Inflation continues to be a big factor, pushing the central banks to keep monetary policy tighter and also raise rates. So, given this kind of situation, we do expect over the next 6 months the markets to be more range bound with a downward bias. So, short term, I'm quite negative on the markets more from Indian perspective. From a longer term perspective, however, India remains one of the shining stars globally, given the kind of huge demographic dividends and the kind of upside that is there from a growth perspective over a decade. So near term, I would probably wait for better valuations to get into, given the earnings downgrades that are expected to come in over the next couple of quarters. So a 10 to 15% downside from a valuation perspective would make India look more attractive. Even though the last few months I've seen the premium that India enjoyed to world and to MSCI emerging markets has come down. I think it's still another 5 to 10% away, which would make us more constructive to look at.
Right. When we just look at, your profile and how you have managed money, you've always been a stock picker. You've wanting to identify and look at stocks at lower levels. Do you think broader markets is the space to be in? Is that the space that, one should start looking at opportunities? Because the last 3 to 4% is very difficult to catch when you just look at the markets.
Yeah, I tend to agree with what you're saying. For any investor, it's very difficult to put the money at the bottom. So what I would like to do is look at the next decade in terms of what kind of top-down stories could play out in India, given the government policy measures and the initiatives of the private sector. So manufacturing is definitely a theme that stands out for us, given the encouragement in terms of the government and also the current capacity utilization levels in the industry. We do see that there is going to be a big spurt in terms of growth in sectors like auto components, textiles, engineering, consumables, and industrials, which would basically be also driven by certain market share gains globally also. The capital goods space is another big sector, product companies where the manufacturing investments that are going to be triggered will bring in a demand for a lot of these companies and their products going forward. Given that India is into a capex more at this point in time, the government also, from its own perspective, has been pushing the infra space. In addition to the the roads and power, we also have additional focus on the railways and defense spaces where localization, etc., is involved and big investments are being made. So this is definitely going to be very good for the positive, very good and positive for the capital goods space. The other sector that is definitely very important from our perspective is the
right.
wealth management.
Krishna got the point in terms of why manufacturing and cap goods should be good. We've had about 4 or 5 big block deals from the start of March. You've been in the markets for around a $2.5 billion deal or a $2 billion deal coming in from Adani and getting absorbed. 18% of Kirloskar just getting absorbed so easily. It's close to about 800 crores. Are you surprised by the way some of these deals are really getting absorbed?
Yeah, if you look at the market, the liquidity in the market is trading volumes are also dried down over a period of time. So the retail participation, etc., HNI participation is much lower than what it was. So one of the ways to deploy capital would be to use the block window basically whenever good stocks are available. And also the fact that the domestic investors are still pouring in about 10,000 to 12,000 crores of SIPs into the mutual funds, and added to that the PF and the pension fund allocations and the insurance allocations. So there is definitely an interest to kind of absorb good companies when they are available, basically. But specifically on some of the names you mentioned, we had a huge valuation corrections on some of the stocks, group stocks that you mentioned, and hence at an appropriate time, some of the stocks in the group which were of good value, backed by good assets, have found buyers basically.
Right. Krishna, in the last 2 years, for the last 10 years till 2020, you would be struggling with companies that have debt. How will they repay? What will do? Will they be able to manage their interest rate? How things are moving in. This time around, when interest rates are going up, you think corporate balance sheets are very strong, and that's why you are not seeing some of the heavy capex companies really go down, because earlier, in such sort of an interest rate environment, you would have seen a lot of capex companies completely derating.
Yeah, I think the Indian corporate sector balance sheets are much more healthier. There's been very less of capex over a period of time, and hence, you've seen the debt equity levels are very comfortable, and also the fact that interest rates go up over the last 1 year. I think, given if you compare it with 2010-12 decade, you would find that the rates are far lower still, in spite of the move up in the last 1 year. So I think there is a lot of net worth that's been built in the Indian corporate space, and hence the worry about rising rates is that much lower, and from an NPA creation in the corporate sector. However, one should be careful of the retail credit. You would have seen that the credit card outstandings are going up, the revolvers are going up substantially. The credit to GDP ratio of the private sector is going up on the retail side. So these are some signs that we should be watchful of, and be also quite cautious on some of these retail consumer lenders.
Right. In terms of some of the metal companies, their profitability is no longer what it was, say, 18 months back, but their balance sheets are very, very strong. How do you value such a thing in this market?
You mean the metal companies?
Yeah, I mean, a Tata Steel 2 years back is not definitely making the same profit as what it was making now, but their balance sheet is substantially, better. Even if they are making lesser profits, how to value such a situation that the balance sheet itself has repaired quite a bit across the board?
Yeah, I think so. Very importantly, I think the leverage on these companies is far lower, and hence the financial risks are far well contained, basically. But however, being a cyclical, I think we as investors would go with a time-tested philosophy of buying these commodities and cyclicals at high P's and sell them when they're at low P's. That's a very typical way, simplistic way of looking at cyclicals, basically. So I think while there is no balance sheet risk, but I think from an upside perspective, I think we need to look at getting the sector right. And typically, the bottom of the sector happens when your profits are probably shrunk by more than 80-90%, and they're trading at very high PE multiples. So I think that is a yardstick that one would like to use if you want to get very aggressively bullish on some of the metal companies.
All right, Krishna, thanks so much for taking out time for us. Always good to get perspective from you. That was S. Krishnakumar talking about his views on the markets, how to value companies, and how to look at the current market situation. Now let's go